You may know Starbucks for its world-renowned coffee, or maybe you know it as the perfect cafe-style study and hangout space. But despite its growing popularity, is investing in Starbucks really worth it? Hi, my name is Ashi Taylor, and today I'll be answering this question by walking you through a financial analysis of Starbucks Corporation. Throughout this presentation, I will give you an overview of Starbucks Corporation and its history, analyzing the company's competitors and their financial indicators, including PE ratio, dividend yield, and more, as well as discussing current events and the company's future, and finally, giving an analysis to determine whether or not Starbucks is really worth investing into. To start off, a little background on Starbucks. It was founded in 1971 by Jerry Baldwin, Gordon Bowker, and Zev Seigel. A few years later, Howard Schultz joined as the Director of Retail Operations and Marketing and allowed Starbucks to begin providing coffee to restaurants. By 1992, Starbucks released their initial public offering to the market, and since then, Starbucks has been focusing on improving their products and expanding both domestically and internationally by acquiring several companies like Seattle Coffee Co., Nestle, Teavana, Ethos Water, and more. Although Starbucks has not merged with any company, they have acquired the few that I mentioned, which has allowed it to broaden its product line and global reach. Today, Starbucks Corporation has expanded to over 31,000 stores and locations, which is more than any other beverage retailer in the world. Starbucks Corporation is in the restaurant industry. Some of its competitors include Dunkin' Brands Group, McDonald's Corporation, and Wendy's Company, which are also in the restaurant industry. Although Starbucks is specifically in the retail coffee and snack store industry, Dunkin' Brands Group, McDonald's Corp, and Wendy's Corporation or Wendy's Company do still offer some of the same products. Just a little more insight into what Starbucks has been doing and what they're estimated to do. In their 2020 annual report letter to shareholders, Starbucks mentioned that they've been working on their growth at scale agenda, which is accelerating their growth in the US and China to increase returns to shareholders, even through the pandemic. Some of these include expanding the global coffee lines to more than 30 markets and strengthening their digital and loyalty programs globally, and adding experienced individuals to their board of directors to invest in the growth of the company. In terms of a press release that was released on October 29, 2020, it states that in quarter 4, Starbucks Corporation reported immense financial recovery since quarter 3, actually more than expected, and opened 480 net new stores in quarter 4, which is a 4% year-over-year unit growth. Although net revenues of $6.2 billion declined 8% from the prior year, primarily due to lost sales related to the COVID-19 outbreak, Starbucks' strong digital presence and adaptability will still allow it to continue growth into 2021. Essentially, with current events and the news, the same message kind of rings through. One thing that is really impacting Starbucks is COVID-19, yet they're still doing better than expected. Starbucks began losing sales in January 2020, which was earlier than other American companies, yet it was still combating these losses by establishing more go-to locations. Starbucks has also closed, renovated, and relocated 400 cafes in the US and Canada to help keep it afloat. Starbucks stock has also bounced back from its spring lows. While growth is slow and the ticker is only up about 2%, where the S&P 500 has risen more than 5%, Starbucks is still expected to outperform original estimations from a COVID-19 induced quarter 3. In addition to this, Starbucks isn't really being impacted by any political or global tensions, including the trade war and the election. Although the US is in a trade war with China, Starbucks has still continued its expansion into the Chinese market. In terms of insider trading, although Starbucks insiders still have a net buy of 18,628 shares over the past 6 months, recent insider trading sales by directors and the CEO may indicate that the stock price is expected to decline in the future. As you can see through this graph, or through this chart, there have been a lot more sales than buys in recent months. In terms of top managed compensation, or the salaries, bonuses, and stock option packages that chief executives of publicly traded companies are awarded, Starbucks' CEOs and top management are more likely to pursue interests that will benefit shareholders, considering their own compensation lies in the growth and success of the company. As you see here, they have been awarded a lot of stock options and stock awards and option awards, which typically serve as an incentive for them to continue improving the company, considering they have their own stake in it. Now we will discuss the stock price history of the company. Through this change in stock price per year graph, we can see that on average, Starbucks shows the greatest stock price growth compared to its competitors and is still doing exceptionally well through the pandemic. Starbucks here is the dark blue line, and you can see that it's risen 359.10% compared to its competitors, which are at slightly lower margins. When we analyze this per week, we can see that Starbucks shows the least amount of change in price per week, which also indicates more price stability. Currently, Starbucks is at a share price of $90.65 per share. Moving on to analyst recommendations, a financial analyst named Justin Hellman reported on August 21st, 2020, that Starbucks is struggling but still managing COVID-19 better than estimates. Their full year share earnings guidance range has risen 20%. Temporary unit closures in June have already started to improve, especially in China, and domestically, share net could also snap back to about $2.9 by 2021, compared to 90 cents a share for this year. Essentially, Justin Hellman is saying that Starbucks is estimated to emerge from the pandemic relatively unscathed, making right now an opportune time to invest. When analyzing other analysts, we can see that for the most part, they expect Starbucks price to go up and expect that this is a good buy. Specifically, Cohen & Co. maintains that Starbucks is expected to outperform or do better than stocks in its sector with a price target of $99, which, if you remember before, is higher than their current price, estimating that they believe that the price will rise to this amount. Wells Fargo maintains that Starbucks is overweight or comprises a higher than normal percentage of a portfolio or an index, which is seen as a sign that the stock will outperform the broader market and others in its sector. Essentially, most companies have deemed the same. Now let's analyze a few more financial indicators. The first of which is the PE ratio. The PE ratio, or the price-earnings ratio, relates a company's share price to its earnings per share. Essentially, a higher PE ratio shows that either the stock is overvalued or that investors are willing to pay a higher share price. A lower PE ratio indicates that you will either get more earnings for your investment or that investors aren't very confident about the company's prospects. Since Starbucks holds a higher PE ratio than the average of its competitors, the stock appears to be overvalued. However, it also shows that investors are willing to pay for more than what the stock is worth, indicating a potential to be a good buy. In terms of dividend yields, or the amount of money shareholders get paid for each share of stock owned, Starbucks holds a higher dividend yield when compared to the average of its competitors, which indicates a higher investor return than other companies in its sector. Typically, a good dividend yield is one that is rising because the company's profits are increasing and they're subsequently lifting the size of their payout, which seems to be the case here. In terms of bond ratings or grades given to a bond by a rating service, here we're analyzing Moody's. Each rating is assigned based on the bond issuer or company's financial strength or its ability to pay a bond's principal and interest in a timely fashion. As we see here, Starbucks and its competitor McDonald's both hold high bond ratings, which are in the lower medium grade range, than several other restaurant industry competitors that are considered in the junk range. Therefore, Starbucks holds a greater financial strength than most of its competitors. In terms of betas, or the measure of a stock's volatility in relation to the overall market, Starbucks has a beta of 0.81, which is less than the average of its competitors. Typically, a beta that is greater than 1 indicates that the security's price is theoretically more volatile than the market, while one that is less than 1 is less volatile. As we see here, Starbucks has a slightly lower beta, signaling that it is less volatile and subsequently less risky. However, since risk and reward are directly related, it also estimates a lower potential return than its competitors. In terms of Starbucks' ROE or return on equity, it is considered not meaningful and therefore will not be used in this analysis. Capital structure, or the way a corporation finances its assets or makes its money for Starbucks, is primarily done through common stock. As we see here, as of June 28th, 2020, the company primarily raises capital through common stock in the form of several million shares, while its total debt is $1.683.7 million and its market cap is $90.6 billion. In relation to its market cap, which represents the market value of a publicly traded company's outstanding shares, the company has a healthy amount of debt. When we look at EPS, or the earnings per share growth rate, we see the profitability of a company. Typically, EPS is calculated by dividing the company's net income with its total number of outstanding shares. Since all companies have a different number of shares, the percent change in EPS per year should be used to compare a company to its competitors. Considering Starbucks holds the highest historical EPS growth rates out of its competitors and is projected to continue being the highest, Starbucks is also more profitable. However, future expected EPS growth rates for Starbucks are lower than previous rates, most likely due to the pandemic. Still, we do see a higher rate than its competitors. Finally, DPS, or dividend per share, is the actual value of dividends paid per share. It's calculated by dividing the total dividends paid out by a business over a period of time by the number of outstanding shares issued, and is an important indicator of how much income investors will make, considering the amount a firm pays out in dividends directly translates to income for the shareholder. As we see here, Starbucks holds the highest past DPS growth rate out of most of its competitors. Although future expected DPS growth rates are lower than historical values, they are still higher than Starbucks' competitors and reflect positive growth, meaning more profitability and future confidence. Another indicator of a company's performance, BVPS, or book value per share, is not included in this presentation, considering not enough information was present to make an adequate decision. Overall, based on these indicators, my final recommendation is to buy Starbucks stock. Starbucks stock is a good buy because, as we've seen, it shows a strong financial record through its EPS, DPS, dividend yield, PE ratio, and other financials, and also shows promising future prospects. It's shown a history of growth, and through their annual report, we've seen that they have devised new strategies for future growth and stayed afloat during the pandemic, meaning that these new ventures will eventually pay off. Additionally, Starbucks shows the greatest stock price growth and price stability out of all of its competitors. Finally, it has shown a great deal of adaptability and resilience throughout the pandemic, overall making this a reliable stock to invest in. Thank you so much for listening to this presentation. I hope I've given you a little more insight onto the history of Starbucks and why it's a good investment for the future. See you next time!